All right, we'll go ahead and get started. Hope everyone had a great week. My name's, of course, Chris Berry. If you haven't been on one of these weekly wisdom webinars, we do these weekly, every Wednesday at 1 o'clock. Then they end up getting recorded. And I have a bird knocking at my window behind me. He's very excited for the webinar, apparently. So if you do have a question, feel free to put that into the Q&A section. I have some questions that are already submitted ahead of time, so I'm going to make sure to go through those first. Okay, someone did just put in another question. Cool. And with that, we'll go ahead and get started. And while I do this, we always start with something positive that happened. I call it a positive focus. We start all of our dinners and team meetings with something positive. And for me, my positive focus is that my son Ryan, who's 10, grab something, is away at Boy Scout camp for the first time. So he's going to be gone for 6 days without mom or dad or grandma or grandpa, with a bunch of Boy Scouts. So it's pretty exciting. He's going to come back Saturday. So with that, let's go ahead and get started. All right. So the first question, if an IRA is inherited by and again, if you have questions, this is really for you. There's no prepared slides or anything or PowerPoint. It's really just asking or answering your legal, financial, and tax planning questions. And if you want to see how this applies to your situation, always make sure to schedule a time to chat with me. So if an IRA is inherited by an estate or trust, according to Suze Orman in a Costco Connection, if the deceased was not taking RMDs, the account must be fully withdrawn. That should be in 5 years. If the deceased was taking RMDs, withdrawals can continue to be made using the RMD method. Is that right? Whose age do they use in calculating the RMDs? Well, here's what happens. So really, this is 10 years typically. And this is the big thing here is understanding the Secure Act. So the Secure Act passed in 2020, and it does a couple of things. And you might be asking, what is an RMD? Required minimum distribution. So prior to the Secure Act, you had to start taking out your required minimum distributions at age 70 and a half. And what the Secure Act did is it pushed it back to age 72. Now, what happens when you pass away with pre-tax IRA money is that all the taxes, because you've never paid income tax on it, all the taxes do not have to be paid right away. Like if mom passes away and there's $1 million IRA, the kid doesn't have to pay all of the tax right away. They could stretch it out over their lifetime, and they would use the beneficiary's age to determine what the RMD was. Because understand that when you inherit an IRA, no matter what your age is, you had to take out RMDs prior to the Secure Act. Now, the younger you are, the lower that RMD might be. So at age 70 and a half, it used to be you had to take out 3.65%. Well, if you inherited an IRA and you're forced to take out RMDs, and let's say you're age 20, your RMD might be 1%. So we used to do a lot of stretch IRA trusts and stretch IRAs where we could leave this money to grandkids where the RMD might be 1%, but if the account's earning 3, 4, 5, 6, 7, 8%, it's almost creating this perpetual kind of income stream for the kids. Well, the Secure Act did away with all that. And now, regardless of your age, when you inherit an IRA, the RMDs have to, or the required minimum distribution, so the taxes basically have to be paid within 10 years. Okay. Now, if it's left to a trust or to a let me rephrase that. If it's left to a poorly drafted trust or to someone other than an individual, then we get to 5 years. But with the Secure Act, it's really a 10-year distribution. And there are some strategies with regards to like spouses, but regardless, no matter what, all the taxes have to be paid within 10 years when we leave it to someone other than a spouse. We don't really have any choice. So this whose age do they use in the calculation? It really doesn't matter. It's just all the taxes have to be paid within 10 years. So it's not based on age or anything. It's regardless of age, all the taxes have to be paid within 10 years unless it's left to a spouse or there's a couple other exceptions. So hopefully that's helpful, and please don't just blindly follow any advice, general advice. It's always kind of the details are what are important. Let's see, a couple questions came in. Does the IRS accept or challenge backdoor IRAs if done properly? Typically no, but they're a little bit tricky, so you have to make sure that you do them correctly. I assume that's, we're talking about Roth IRA. Yep. Meaning backdoor traditional contribution from Roth conversion, no deduction of taxable income. So I'll just kind of jump ahead. So the concept here is what's called a backdoor Roth. And so just kind of basics, the Roth, this money grows tax-free. So especially if you think taxes are going up in the future, you want things that are in the tax-free bucket. Things like Roth, also cash value life insurance or IUL, 529s, HSAs. And these are kind of your tax-free income sources, but we're talking about a backdoor Roth. So the thing with a Roth is that there's contribution limits based on your income. So if you make too much money, you might not be able to contribute to a Roth. That's why a lot of people would look to actually IUL. Kind of the nickname for this is rich man's Roth, because again, there is no income test for the IUL, but there is kind of a tricky strategy where you contribute money to like a 401k or IRA, typically an IRA, and then what you would do is then do a Roth conversion kind of in that same year. So it's allowable. It's a little bit tricky, but yeah, the IRS does allow what's called backdoor Roth IRA. So if you are over on income, and normally you wouldn't be able to do a Roth contribution, you might be able to do a Roth conversion using that backdoor Roth strategy. So I answered that question. So husband's IRA goes to me, wife upon death. If I am gone, then it goes to the trust, which is supposed to go to the kids. So 10 years to them or 5. Yeah. So any of our trusts, the question is, if we leave it to a beneficiary or a trust, would we get 10 or 5 years for the stretch? And if it's one of our trusts or a trust that's well drafted, you'll get the 10 years because the trust will qualify still as a designated beneficiary. So really, for any of our clients, the kids will get a 10-year stretch, whether we leave it to the trust or to the individual beneficiary. All right. Let me just see. All right. Seeing what other questions. All right. Any indication that RMDs will be waived this year? No. So what happened last year is even if you're over 72, you didn't have to take a RMD because the CARES Act waived that for last year with all the craziness that was going on. There really hasn't been any inclination or indication that they would waive RMDs. And to be honest, depending on your situation and me just generalizing, I go the other way because almost everyone agrees that taxes are going up in the future. So I wouldn't take an RMD. Like last year, I'd advise clients not to take the RMD, but instead do a Roth conversion. So the thing with the RMD is the RMD has to go into a taxable account that now you're taxed on capital gains. But if you do a Roth conversion, move the money from the IRA to the Roth, then now this money can grow tax-free. And if you think taxes are going up in the future, you need to understand we have these tax buckets of taxable, tax deferred, and this is where your IRAs are, and tax-free. So RMDs force you to take the money and put it in the taxable account. Even better would be to try to do a Roth conversion and put the money into the tax-free bucket. So if you're taking out RMDs now, what you'd want to do if you want to get more money into the tax-free bucket is figure out where you're at in terms of the tax brackets and figure out how much additional on top of your RMD you would want to convert. So this would be like a Roth conversion here. Well, this is your RMD. So again, we want to, if you think taxes are going up in the future, you want to get as much as you can over here, or even to the estate and income tax free, depending on the size of your estate. Because Roth is tax free, but it's not estate tax free. Cash value life insurance, if it's in an ILIT, is estate and income tax free. So, getting back to the initial question, no, there hasn't been any indication that they're going to waive RMDs this year. That could change. But as of right now, no indication there. A lot of RMD questions. Can you take RMDs, required minimum distributions, for your spouse's account? So let's say we have husband and we have wife, and let's say there's $1 million IRA money here, and let's say 1.5 million in the wife's, right? And you're both over 72. And I'm just making up numbers, but let's say the RMD together is 60,000. So we have to take 60,000 between the two of you out of the RMDs. Again, I'm screwing up the math as I'm doing this on the fly, but let's say 35,000 of it would be having to come from the wife, and 25, is my math right? That should equal 60. Yep. Okay. So the question is, okay, if we know together we have to get to a RMD of 60,000, could I take the full 60, let's say, from the husbands and allow the wives to continue to grow? Unfortunately, the answer to this is no, you can't do that. You have to look at your individual IRA amounts and calculate the RMD separately. Now, the question does add in, I know that you can take RMDs from one of accounts. Yeah, so you might have multiple IRAs. So let's say a husband has a couple different IRAs. If you wanted to, you could take all of that 25,000 from one IRA, okay? And you could allow the other ones to grow. That's why a lot of times in our IRAs, we'll have kind of two buckets of money. One, so if this is an IRA, because we know that we have to pull money out, we might have one bucket that's more kind of safety focused, and then another portion of it that's more growth focused. So if it's a down market, then we pull from the safety side. If it's an up market, we pull from the growth side. It's a way to satisfy those RMDs. So you can take it from different accounts, but if we're married, you cannot, your spouse has their RMD, you have your own RMD. So the answer to this is no. All right, a couple other questions that came in here. Husband retiring next March, congratulations. I assume that any Roth contribution would be limited to his income for 2022. Yeah, so example, he earns 1,500 by March retirement, so we can each contribute 7,000 to our individual. Yeah. So this is getting to Roth contribution. So the answer to the question is yes. You can, if you have income and maybe only one spouse is working, both spouses potentially could contribute to a Roth. Normally a Roth contribution, you can put in 5,000, but if you're 50 plus, then you can put in 7,000. And so it could be each spouse can put in that amount. Now keep in mind, this is something that's always confusing. That's different than a Roth conversion. You can do Roth conversions whenever you want. All you're doing is basically taking IRA money, moving it to a Roth, and then out of the cash you have sitting in maybe checking savings, you pay the tax. So you can do any amount, and there's no income tests, and you don't have to be working to do a Roth conversion. Anyone can do a Roth conversion. Roth contributions, the key is you have to have income, earned income. or one of the spouses does. All right, now this is the last question I have. So if you do have anything floating around in your head that you want me to answer, please submit it now. Please explain why long-term care may be a good investment better than FIA or IUL. Maybe some clarification on that. So please explain why is long-term care a good investment better than FIA or IUL. Okay, so this was kind of what was submitted, and feel free to clarify if I'm not capturing the question correctly. Why is long-term care, I'm assuming insurance, a good investment better than FIA or IUL? I don't know. I can't, well, I'm not, okay, so it is insurance. I can't say it. I would never say that. I don't think any investment is good or bad. I think they're all tools. It depends on what your goal is. And in fact, pure traditional long-term care insurance, I would hardly ever use that tool anymore. So let's say our goal is we want to address, so what is our goal, right? So what is our goal? So let's say our goal is to address long-term care costs. So we're concerned about long-term care costs in the future. There's different strategies that we can utilize to help address this. So what are the potential strategies? Well, one is a legal strategy where we can move money into an asset protection trust. And if we make it 5 years, everything inside of the trust is protected from that nursing home Medicaid spend down. We could look at a kind of financial, well, let's just talk about pure long-term care insurance. So to be honest, I'm not a big fan of pure traditional long-term care insurance. The reason for that is, sure, it addresses your goal of long-term care, but there's two big things. And I've had a lot of clients, or a lot of conversations with clients that have purchased these. First of all, the premiums can increase on you at any time. I just got off a call with clients this week where they purchased a policy a number of years ago before they met me, been paying on it every year. I think their premium is like $3,000 for one person and $2,800 for the other. And they just received a notice that unless they kick in like an extra $1,000 a year, that their policy benefits are going to go down. So one problem is the premium increases, and then also any value with these is lost at death. So really, we saw a lot of insurance companies get out of the business entirely. So if you have a pure traditional long-term care insurance, I'm not saying just let it lapse or anything, because it might be a good policy to maintain. But really, I wouldn't recommend typically pure traditional long-term care insurance for an individual. Instead, that's where we look at more of a kind of financial insurance strategy, where now we get into tools, and maybe we look at index universal life, which is cash value life insurance that could be used for tax-free income, where the cash value grows, and if the market goes down, you don't lose anything. The market goes up, you get the upside. And then the death benefit could double as a long-term care benefit, or what I call asset-based long-term care, where now we're just purchasing a death benefit that doubles as a long-term care benefit. So it might be a $500,000 death benefit that also could be used for long-term care. So you're either going to need it for long-term care, or if you pass away, then whatever is left of that policy would go to your beneficiaries, potentially tax-free. So Getting to the question, why is long-term care insurance a good investment? I can't answer that without knowing what the goals are and the strategy. But if I'm looking at the specific tools, I probably would look at maybe an asset protection trust, cash value life insurance, asset-based long-term care, or there's even fixed index annuities, FIA, sorry for all the acronyms, fixed index annuities, where we can turn this into an income stream for life. And then if you were to need long-term care, the income will double if you need long-term care for a period of time. Nice thing about this is there's no underwriting versus these two would have underwriting where you have to be relatively healthy. We could do this, like if you had a loved one that was already diagnosed with Parkinson's or something like that. So hopefully that was helpful. And if you want to talk about your situation, feel free to just reach out. Okay, another couple questions. Can you explain, I just did that one. On the conversion, so we're getting back to the Roth conversion. Can you have them withhold the taxes out of the IRAs so that you would have the money withheld when you do your tax return? You can, but it's going to put less money in the Roth. It's probably not the ideal way to do it, but if you don't have the cash on hand, yeah, you just take out more, pay the tax, but that's going to put less into the Roth side. So you can do that. Are there any secure investments that have a higher rate of return than the very low rates currently offered by banks and treasury notes? Yeah, so really any specific investment has 2 out of 3 characteristics at the end of the day. So this is, I'll do the question again in a second. So you can only have 2 out of these 3 characteristics in any specific investment tool. So most people want their money to grow. Most people don't want to lose their money. So they want safety, and then they want to access their money. Okay. They want liquidity. So what is money that's safe and liquid? This is typically money you keep at the bank. So this is your checking, savings, money markets. The nice thing about this is that it's safe, meaning you're not going to lose money, though you are technically losing to inflation, and it's liquid. So you can pull the money out at any time. We typically call this your now bucket of money. Think of it as the money you might need over this year. Then any other money that you're not going to need over the next year should probably be more geared towards growth. And so we can have money that's geared towards growth and liquidity. And this is having money in the market. Okay. And we can have aggressive portfolios, we can have conservative portfolios, and we can have everything in between. But this money kind of typically goes like that if you look at how it grows. And then we can have money that's geared towards growth and safety. And so here we have things like CDs offered by banks, pretty short term, but what are you getting in terms of rate of return? Like maybe 1% if you're lucky, maybe 2. They're really not worth it. Like everyone's refinancing their home because of mortgage interest rates are so low. Well, guess what? That's also affecting other fixed interest rate investments like CDs, your interest rate on your savings account. Taking it one step further, we also have what's called multi-year guaranteed annuities. Multi-year guaranteed annuities. These are basically the same thing as CDs, but offered by insurance companies. You might be getting a 2 to 3% rate of return. So those are both fixed. Okay. So if you move into a CD and they're offering you 1.2%, you're going to get 1.2%. That's it. There's no other room for growth. So really big picture, I'm not a big fan of moving money into CDs or multi-year guaranteed annuities because interest rates are so low and now you're going to be stuck in this low interest rate environment. So what are some alternatives? Well, if we're willing to give up a little bit of liquidity and say, hey, this is money we're not going to touch for the next 3 years at least, then we might get into things like fixed index annuities and index universal life. The way that these grow is that if the market goes down, you don't lose anything, but if the market goes up, you get a portion of the upside of the market. Okay. I just got my IUL policy as of June 3rd, and my policy was up 8.4%. So that's pretty good for something that has downside protection. But typically you're looking at rates of return anywhere from 5 to say 7% over here with the downside protection. The sacrifice is that we have to give up some liquidity where we wouldn't want to liquidate either of these right away. So that would be, I guess, the alternative if you're looking for secure investments that have a higher rate of return than the very low rates currently offered by banks and treasury notes. So yeah, we can get you a 5, 6, 7% rate of return with downside protection, but we'd have to give up some liquidity to do that. The idea is that we're not going to touch the money right away. So hopefully that was helpful. All right, any other questions? If you have another question, please submit it. Going once, going twice. And all right, well, have a great week. Thank you, everyone. It was a pleasure. And if you do have questions, thanks for the answers today. You are very welcome. Good to see you. If you do have questions, feel free to submit them. Thank you. You're welcome. Otherwise, I'll see you